Goldman Sachs, $8.35 billion in profit, the year after the worst financial collapse in modern history. While millions of ordinary investors were wiped out, I worked inside an investment bank, and I can tell you, it wasn't luck. They knew things you didn't. They still do. This is what they never tell the public. Here are three of them. The stock market looks like a level playing field. Same stocks, same prices, same news. But here's the problem. The information retail investors see and the information institutional desks act on, they're not the same thing. To understand why, you need to understand one fundamental truth about how financial markets actually work. Most people think stocks are traded on public exchanges like the NYSE or NASDAQ, and they are, partially. But a significant portion of institutional trading happens somewhere else entirely. Places called dark pools. Think of it like this. Imagine you want to sell your house. You could list it publicly, and immediately everyone in the neighborhood knows your price and your urgency. Or you could quietly find a private buyer before anyone else finds out. That's what dark pools are for banks. Private trading venues where large orders move without tipping off the public market. The result? By the time retail investors see a price move, institutions have already executed. But dark pools are only part of it. The second thing banks know is even more important, and it's hiding. Retail investors make decisions based on earnings reports, price charts, and news headlines. That's the publicly available layer. Banks use all of that too, plus something else. Proprietary research, satellite imagery of factory parking lots, credit card transaction data, alternative data sets that most retail investors don't even know exist. I'm not telling you this to make you feel powerless. I'm telling you because understanding the gap is the first step to closing it. Here's something that surprised me when I first entered banking. Research analysts at major firms almost never issue a sell rating on a stock. The data backs this up. Across Wall Street, fewer than 5% of analyst ratings are sell. The vast majority are buy or hold. Why? Because the same bank issuing the research report often has a business relationship with the company being analyzed. Investment banking fees, advisory mandates. The conflict of interest is structural, not personal. And retail investors read those by ratings and treat them as gospel. So what can you actually do with this? That's the part most finance videos skip. Here's the legitimate way to use what banks know. Every quarter, institutional investors managing over $100 million are legally required to disclose their holdings to the SEC. It's called a 13F filing. It's public, it's free, and almost no one reads it. This is as close as you'll get to seeing what the smart money is buying. Not in real time. There's a 45-day lag. But as a signal for long-term positioning, it's one of the most underused tools available to any retail investor. Banks didn't build their advantage overnight. They built it through access, infrastructure, and information, compounded over decades. You won't replicate a Goldman Sachs trading desk, but you can understand how the game is actually played. And that understanding, knowing where to look, what to ignore, who benefits from what you believe, is worth more than any hot stock tip. The market doesn't change. The players do. Same game, same rules, different levels of information. Most financial content sells you something. This doesn't. Follow if that matters to you.